Welcome to an overview of the highlights of the updated mini storage financial model template from efinancialmodels.com. This is a Microsoft Excel spreadsheet developed to analyze building a new mini storage site and take into account all the costs, the required investments, the financing, and how to lease up, generating revenues until the building is fully leased up among investors. Before we dive into the highlights, please don't forget to hit the subscribe button to get notified when we have new videos released. A link to the financial model template used in this video is included in the description below. Let me first explain the structure of this template. As you can see, we have different worksheets. Important is here a central assumption sheet, but we also have assumptions for the investment budget to build the mini storage site, then also in more details how the ramp up of the different boxes is going to happen, and then also a sheet with more details on how to model the expected ramp up of the storage boxes, and we take into account which boxes will be rented at which point in time, the expected occupancy rates, expected lease rates, and then this all leads into the projected rent roll for renting the mini storage boxes. Then we have two sheets with financial summaries. There's a one-pager executive summary included, and there is a more detailed financial summary with detailed schedules included. Two sheets with calculations. The sheet projections basically includes all the calculations of this model. It combines these three assumptions and turns them into a financial forecast. And the sheet investor calculates the cash flows from investor level. Please note you have here these buttons which you can basically open and unhide additional columns which are currently hidden, and the same also here on the side with certain rows which are hidden. Then you will see that we also have different worksheets included, which includes presentation with the key points of this analysis. This is in light green here. And this is something you could also print, or you could also present to somebody to explain your project. That's the whole idea of doing that. These worksheets are basically the same as the tables you have on the summary sheets, but they are presented a bit more in a way which highlights the message you want to give on each of these topics. The model uses different color codes. What you see here are the assumptions. They are marked with this dark blue color. This means these are the inputs going into the model, and these are all over the place. You find them everywhere. And then you will see that we also have assumptions in light blue, and these are basically inputs which currently are linked to somewhere. For instance, here if you have a capex budget under the build scenario, we assume if you would rent it, you would still have these capex positions, so we have linked it here, while the other capex positions would not occur, so we have here them put as dark blue. And the idea here is to invite you, if you see that this doesn't apply, you can simply go overwrite this, change it to dark blue, and reset this to 0. But it's just for us to keep track which cells are linked and which ones are the real inputs. All the calculations are then in cells with black colors, and we also have some font colors we use is dark green. This indicates for us there is a link to another worksheet. So you see this is linking to this worksheet, I think down here, and so that we can keep track and understand the structure of the model. So this is summarized here. You have these 4 color codes used in the model. What you also have in this template is a sheet which summarizes a suggested work plan, and you can just work through the steps 1 to 3, and you also find the links where to get started. Let's first talk about the cost it will take you to build this mini storage site. And for this we have here a worksheet. It's called capex budget. And the idea is that you simply are going to list all the cost positions which will occur, and then that you will allocate it to one of the fixed asset categories, so that later we know how to depreciate those assets, and inputs where you can basically use to estimate this capex budget. And then this is all summarized here, and we'll go into our assumption sheet. This is for the scenario we were to build. If you would rent, the question is which of these costs would occur, so you could simply take some of those or then put the rest to 0. And then what you can do is you can switch between build and rent to see what would be the difference if you would rent instead of build the site. The other question here of relevance is, once you have the cost defined, you need to also define by when these costs are going to be spent. And as you can see, we have here a monthly forecast period stretching out for over 10 years. And starting in month 0, month 1, you see here the counting of the months. And you simply need to allocate how much of these costs are going to be spent during which period. Normally such building such a site should take within a year, so we assume that most of the cost will happen here. And then what you need to do is to check that all this adds up to 100%, so that all the costs of your capex budgets are allocated and we know the exact timing this is supposed to happen. For the leasing and the ramp up of our mini storage boxes, in the worksheet we need to define the types of boxes we are going to rent. As you can see, there are placeholders for 10 types of different boxes. They will have different sizes here in volume, and if we enter also the height, we can also calculate what's then the height and the area per box. And as you can see, this is in metric system. If you don't want to use this, you're going to change the unit, and you could change it to square feet, and then the labels will update and you can calculate the whole forecast in a different unit system. So we're going to define what size of boxes we have available, and then we're going to define what's the average rental price per box. In terms of the number of boxes, we don't enter it here. We're going to detailed sheet. As you can see, we have basically here then on the sheet mini storage rent roll, we have all the different sections depending on the layout of the building. We define for each section what type of box we have here for rental. This will then pull up the box size, and we say how many units of these box types we are going to rent. That's all we want to do. So at the end, we can calculate the number of boxes, and which then is the basis for our forecast. As mentioned, the price we enter separately, so that we know on average how much we're going to charge for each box size. Now the next item of our assumptions is basically when the ramp up and the rental starts. For this, we have here, we need to look at the timing assumptions. And if you remember the capex schedule, we enter here when are we going to spend, and this means at one point the building should be construction, spending of capex stops, and at this point this means that construction is completed, and then the next month ideally we could directly start with renting the boxes. And then all we have to do is we need to look at the occupancy rates, how we're going to ramp this up, and here is the section below. So you can see here we have 9 months, nothing will happen because the project is under construction, and then here we're going to apply the expected occupancy rate. Here is just an average because we are at this point we don't know which boxes are going to be rented, but on average this should be whatever assumption we put in here as the expected occupancy rate. And these assumptions, we have a section here where we're going to say what is the expected occupancy rate in the years going forward until the rental of these boxes is stabilized and reaches the target level. And then these assumptions will be applied to ramp up the rental of the boxes. And what we then do is to translate these occupancy rates into, on the upper schedule, how many boxes will be rented at which point in time. And if we look then at the yearly figures, you can see this will then translate into this ramp up. To complete this, we then also take into account the lease rate of the boxes. Please note that we adjust this here for inflation, so the lease rates over time, they go slightly up. If you look at the annual lease rate, this is the lease rate per year. This goes up due to inflation. If that shouldn't be the case, you just go back and adjust the inflation assumption. This you can find here, cost inflation, and then for the lease rates will be the price inflation. Having this set, we then can build another schedule which then calculates the expected revenues, and we can calculate how much revenue we expect. And as you can see, during a construction there are no revenues. Then the revenues are increasing because as we going forward we're going to rent more and more boxes, and then this leads to the increase in expected revenues going forward. Our forecast, so that we know from the rental of the mini boxes how much revenues we can expect, taking into account our ramp up schedule. Now we also want to think about if there are any other income sources apart from the rental of mini storage boxes. And for instance, there could be services we're going to incur or to obtain. And for this we basically can have your placeholders where you can estimate also service income, and then also we have maybe if there are other areas which are not in the form of mini storage boxes to be rented, if we have simply warehouse spaces, we can also enter these assumptions, the expected areas and rental rates we're going to obtain, and then also same as the ramp up of the mini storage boxes, also the expected occupancy rates. In addition, also parking. We might have some parking spaces we can rent, and if that's the case, we can also enter it here. Otherwise, simply put it to 0 and the revenues are not taken into account. So this allows us to complement our income and basically see how we can optimize the whole income for the building. Once we start operations, we will not only have income, but we will also start to incur costs. These costs can be in the form of employee costs. So here we need to estimate the number of full-time equivalents. This is needed to operate the rental and the administration of the building. There are salary levels that will give us the forecasted employee costs. If in case we would lease the building, if I would put instead of build, we're going to rent, then we would also have lease expenses here, but in our scenario we're going to build, so this is not the case. But we will have other costs which we need to take into account, OPEX for operational expenses, and we can simply estimate on average how much we expect on a monthly basis. Please note these will start to incur as soon as we enter into operations. In case we have costs before that, during the construction period, there is one line item called setup costs, and you can enter those costs which are just one time during the initial launch of the project. Apart from operating expenses, in case this project is managed by a project manager or promoter, we might also have to take into account management fees. We have here foreseen 3 line items: development fee, a fixed monthly fee, or a performance fee, and you can enter these assumptions. A development fee is a one-time expense. A fixed monthly fee means we basically every month we take an expense into account, and the performance fee most likely would be linked to revenues, so we can take a percentage of revenues, and all this will then add up into the forecasted management expenses. And below we can then see a short summary of our forecast. This comes from the sheet projections, where we basically start to build the forecasted income statement. This is all done on a monthly basis, but then later on aggregated on a yearly level, on an annual basis. And then this table here summarizes our forecast. So if you see these figures don't make sense, you can go scroll up here and change the input until the whole picture starts to make sense. Now we need to look at the financing side of our project. So we have, as entered in the forecast, we have entered a certain budget which is needed to develop the site. So we'll need some net working capital. At the beginning we will incur some losses, and maybe we'll need a cash reserve at the beginning. And what I can do is I can basically say that here I want a rounded amount for the equity financing to be made. This is all calculated by the model, but what I can do is I can just goal seek for a rounded number by just adjusting the cash reserve. And then you will see here we have 4 line items about which are financial debt. And here we need first to define how much debt financing we can obtain. And the starting point for this is we have the required capex it costs to develop the site here in this example, and then we are going to define what will be the debt facilities. In this case we have a capex budget of nearly 3 million, a certain percentage which can be obtained by debt financing. We also accrue interest during the construction period. We have an interest rate, and then we can say from when to when the drawdown of this facility will happen, either at the beginning upfront or then during the construction period. If at the beginning we don't have a lot of cash since we're leasing up the building, so there might be a grace period we can negotiate with the bank. You can enter the number of months and then also the expected repayment terms. In this case we don't have refinancing yet, so this would be a 25-year mortgage which will then be repaid at the beginning of the project. The model will calculate all this and then update the uses and sources of funds. At the beginning we don't have refinancing, so I set this to 0. We don't also timing, so basically the first 2 they are mortgages for 25 years, and then this gives us here basically uses and sources of funds. Please note that you might need to fine-tune the debt schedules. You can follow here the links. It will take you to the sheet projection, and you can see that for each financing facility we have here plotted the exact drawdown schedule and then also the repayment. And here we have different In terms of repayment schedule, you can here select what options you want. Either we want to have a fixed monthly fee, which includes amortization and basically repayment of the principal and interest, or you just have a defined amortization schedule, or you enter a manual schedule, or you have a bullet payment at the end. So any of these 4 ways how to forecast the repayment is offered here. And you just need to double check if this is correct, when the repayment will start, when does it end, and which payment schedule. You can see here is a bullet payment, when this will take place. And here you go. Then it will basically plot all the drawdown and the accrual of interest and repayment. This is done for all of these stepped financing schedule, and then summarize so that you get the overall schedule. All these calculations take place here. As we now have entered all the assumptions, we want to see the results in terms of our financial statement forecast. So I'm going here to the sheet projections, and where you can basically find the income statement, the balance sheet, and the cash flow statement. And I want to double check how this forecast now looks like. I have here, these are quite a lot of figures, but I have here a monthly forecast. You can see how the ramp up will affect my profits, expected profits going forward. I can also see by when I should reach break even. And if I want to zoom out a bit, I will look at the annual forecast schedule. So that's either here, or we can then go on the financial summary sheet, where all this forecast is again summarized in a bit more condensed manner. Important is to understand not only the forecasted profits, but actually also to have a look at the cash flow statement. When is cash coming in? When is cash coming out? So we have here cash flow from operations. First we have to do the investment. Then once the investments are done, we will basically enter operations. At the beginning we still have losses, assuming that it takes a while to lease up the building. And then we also need financing cash flows. We get some financing from debt financing, and we also have to inject some equity capital to finance. And then you can see that only after a while, the project's cash flows, the operating cash flows, they can cover the cost of the debt service and the repayments, and then positive change in cash. In this case, we are distributing dividends so that we always keep the cash balance constant. And then this allows us to understand if we have sufficient cash for the project, when does cash come in and when does cash come out. Also to mention, we want to have a look at the forecasted financial ratios. We want to understand, for instance, also the yields, if this is in relations to the original investment, the gross yield, net yield, unlevered cash on cash yield, and then the levered yield. So we want to be sure that this building leads to a positive yield. And we also might want to have a look at the debt schedule, and basically this would be the section then to present to the bank. The bank wants to see that the debt service is always covered. Taking one step back to mention, there is also a free cash flow forecast included. We look at the cash flows before looking into debt and equity financing. Just want to see how much cash requires the building by when, and when does the building produce positive cash flow. So that's the unlevered cash flow. And then when we take into account the drawdown of debt and the repayments, then we can also see what is the expected cash flows from this project. Then what we can see is what are the expected cash flows from the project and shareholders' perspective. This would be the money going to the benefits in the pockets of the shareholders. First they will have to invest, and then what the project generates, and after basically repaying all the debt, interest, etc. This free cash flow forecast and the whole project will then result into the financial metrics, summarizing here once more what's the required investment after debt financing, what's the multiple, and then also we look at the expected IRR. As you can see, the levered IRR, that's based on the levered cash flows. We have less investment, we get a benefit, and this normally should be higher than this, where we have a much bigger capital outlay, and then we compare that to the cash profits this project generates. Apart from the IRR, which assumes that this amount has to be reinvested, we can also look at the average cash on cash yield. That's basically this row here, and just taking the average yield on our investment this project should generate on average the next 10 years. These metrics would then basically serve as the basis for making a decision if the returns are sufficient to go ahead with this project, and you could also compare these returns to other projects, and because then you can decide which project requires how much investment and which project has which type of return. Given this is a real estate project where we have to build a building first and then want to understand what's the value of the building after the building is fully leased up, we can look at this chart here, which basically compares the initial investment which goes into a building and then once the property is leased up, the value of the building. And this is calculated on an exit valuation. So what we look at in this case, it's the exit is in year 10. Assume. So we look at what's the property rental income, then we deduct all the costs, you can include or exclude management fees depending if it's justified or not. We look at the net operating income and we apply the yield, which has helped us to capitalize this net operating income, and we get to the property valued, and we can basically base our valuation on the capitalization here. So we take the higher of this, and this would be the value at exit. And if we want to look at this over time, we track the value of the building also at any point in time, and there is also a graph included. This section here explains this a bit more, how this develops over time. So you can see this is the initial investment we do to build the building, and then as the building is leased up, the higher the rental income we can obtain. We capitalize in this case at I think 7% of gross of the rental income, and then this means that the building value basically increases, and that's the value we can create, and then this project basically can benefit from this difference in value. This valuation is taken into account when looking at the free cash flow forecast, because we have to attribute an exit value of this building and to conclude which then goes into the financial metrics. This spreadsheet allows you to simulate the refinancing. How does this work? So at the beginning of the project, we are financing the project simply via a first mortgage. And in this case, we have a certain building value, but we don't know yet how much rental income this project is going to generate. So whatever valuation we put forward, maybe at the beginning is a bit lower, and we then raise from the bank. And then if we look at the cash flow statement, you can see what we draw down the debt here, and then at one point we have to repay the debt. In this case, this is done via exit, but we can this is done later on, but we can change this. What we can do is this would look like that. In this case, this is a fixed service payment. If we do that, then we will have to repay debt as soon as the project starts to be operational. And then you can see only after we service the debt, only then we can pay ourselves some cash here in the form of dividends. In this case, we have an effect that the property valuation is going up. So if we raise debt financing here 60% of 3 million, that's a lower amount. But if we would raise 60% of 10 million, that's a higher amount. So once the building is fully leased, what we could do is we could basically raise a new debt facility, use the proceeds to repay the first, and then pay us out some dividends. How to do that? In this case, we do it like this. So we assume that first there will be a refinance. Let's say this will be 65%, but of the property value. And then we say the refinance, for instance, takes place in month, let's say 49, or we could say even a bit, let's say 61. And then this means that these first facilities will get repaid in the month 61, and then we refinance with the new facility. And in that case, we change this here that there is not much, or we can leave it, so there is some debt service. Now let's see how this looks like. We look at the cash flow statement for this, and now what you can see is here everything is the same, but then here there is this month 61, and then you can see this is the debt drawdown from the refinancing. If we look at the assumption, you can see this is the amount, this matches, and then you can also see that there should be a debt repayment. In this case, it would be better to assume a bullet payment. We could use a manual schedule here, and then we repay a big chunk. We have basically here, this is repayment of the initial mortgage, and then here this is repayment of the refinancing facility. And now what this allows us to do is, if we can raise more debt, then we have to repay the first debt. We then can take out a big dividend, and this big dividend will then impact the levered IRR, the returns and profitability of this project. So this is the IRR including the refinancing, and if we undo all this, we say there is no refinancing. Voila, we go back to fixed service, Okay, we go back, and then you can see this IRR is lower. Why? Because here we have to wait longer until we get the cash, but if we can manage to negotiate with the bank to give us a higher mortgage and use those proceeds to pay us out some money, so we, for instance, can reinvest in other project. So in that case, we have a refinancing in there, and our returns go up. Let's show that once more. Here, this would be end, bullet pays end. And you see the returns are higher. So that's the benefit of doing a refinancing, and the point is this template allows you to play around with this and see which scenario can lead to which returns. Now let's look at the shareholder levels, but let me first here adjust this amount once more. This should be, I like to use a rounded figure. So we need to raise 1.7 million from investors. And for instance, here we have these different types of investors, and then each of those in this case contributes the same amount to investment and will get the same equity stake. One option, however, could be that you start to change this. So basically, let's say if this one would put in more, and then you basically, hold on, 25. So it also could be that, let's say 15. This is what I wanted to show you. So in this case, investment, meaning the founders don't put anything in, but they get 10% of equity stake. So that's one way to model this. In that case, the founders will get a higher IRR than the other investors. In that case, that we don't do this profit sharing, we just look at the returns, and we have here a section which looks at the returns from an investor point of view. And you can see here the founders, it's not possible to calculate the IRR here because the investment is zero. I cannot calculate the return if there is no investment out. And the others, they will have different share of the money put in and money out, so they will have different returns. So that's one way to look at it, and the basis for that is that we take into these basic assumptions and see who puts in the money and who gets how much. And at the end, they basically participate in the exit depending on their equity stake. The second way to look at this model is basically to keep all this the same. So basically, everybody puts in a certain investment and gets the same percentage as equity stake, but the roles here might be different. The founders or the developers, promoters, they could take the role of a general partner, means an active partner managing the project, and then the others would take the role of a passive investor, a limited partner. If we would do that, he has to work, they can sit back, so he needs to be compensated. How to do that? We could use the compensation based on performance. So we can use here a profit share assumption and basically say we have here different tiers. So if the return is up to 8%, the channel partner, we look at the return from the limited partner. So the channel, basically up to 8%, the limited partner does not have to share any profit with the channel. The limited partner doesn't have to share any profit with the channel partner. If the return is between 8 to 12%, we say 15% of the LP's return have to be shared with the GP. So here the GP starts to make money because the project is starting to generate attractive returns. If the returns even get higher, we increase the profit share. Instead of sharing 15%, we share 20% of profit, between 12 to 15% return. So another way to motivate the channel partner to maximize the project. And if the returns are even higher for the LP, then we can say anything above, in this case 15%, the GP gets 25% of the LP's return. And if we look at that, then in that case, but let me shortly correct here one thing. We want that the channel partner also puts in some money. Now let's look at the financial summary. And now this is what I want to show you. We can see how much, who puts in how much of the 1.7 million, who gets how much of the profits, and this takes into account here all this profit share. And then you can see the GP, the founders, they get a higher return because they basically charge this performance fee from the limited partners. That's why the return gets higher, and the others, they will have to pay this performance fee, so their return is a bit lower. But still, this is an excellent return if you look at that. And this then allows you to model these type of scenarios. So this spreadsheet template allows you to model the profit share of investors based on these two modus operandi. Then something else we want to do is to look into scenarios. We want to understand what would happen, for instance, if the investment costs are higher, what happens if the expected lease income gets higher, and we want to understand what's the effect of these key metrics. The way to do this in this template is that we have foreseen this case we can run, instead of build, we could do a rent scenario. The model will calculate us everything through, and then suddenly the returns get different. In this case, the issue is that the cash flows are positive, negative, negative, positive. So if that's the case, we have to change the assumptions, because it's not mathematically not possible to calculate this. We need first negative cash going out and then positive cash flows. Basically, the lease rate or the rental rate per box, for instance, gets 20% higher, and we can see that this will then positively impact the returns. But on the opposite also, if the costs would get higher, doesn't affect a lot the return, it gets a bit lower. So we have to only to go back here, but let's say if the costs are a bit higher, you can see that here the returns are 1627. If I remove this, you can see it goes back, it's a bit higher, so it doesn't make a big difference. But let's see how this would look like if, let's say, if we have much more cost of the building gets 20% higher, and in that case you could also see the effect here on the returns. So this is a very simple way to understand a bit how the financial scenarios react if some of these assumptions would result differently than what we have foreseen. So I hope this overview was useful to give an impression what this template can do for you when you analyze your next mini storage development project. And the spreadsheet itself you can find on our website. A link to the model template is included in the description below. If you like this video, please give it a thumbs up and subscribe to our channel to get notified when we release further videos. And please visit our website so that you can see what other templates we have available. Thank you for watching.